Right, let's get more on today's rally as well as the outlook for 2023. Bring in Wells Fargo Securities, which expects growth stocks to make a comeback. Chris Harvey joins us now. He's the firm's head of equity strategy. Chris, great to have you with us.
Good to be here.
Very tanned and relaxed, Chris Harvey. You like services over stuff. That's a big theme for 2023. Does that mean tech? Does that mean growth? What does that mean?
It doesn't mean tech. So we're underweight tech hardware, and that's part of stuff. Just quickly on the theme. The theme for 2023 is services over stuff because the U.S. consumer has gorged him or herself on housing, on cars, on goods. They have a new basement. Their basement is full of stuff. They have a new garage. Their garage is full of stuff. Stuff's falling off the shelves. What we want to do and what we expect to see the consumer do is move from spending on goods to spending on experiences. Where that puts us, we think the fat pitch for 2023 is mid-cap growth, because the environment is going to be more conducive to growth. We think you're going into an environment where where inflation is coming down, where economic growth is slowing, where rates have either peaked or going to peak. And then when we looked around the growth space, we still don't like large cap growth, but we looked at mid cap growth and you're trading at 14 times earnings. You've derated for multiple years. You've got an oversold situation that's beginning to bounce, and you've had expectations that have been lowered. So we think that fat pitch, that best risk reward for 2023, is that mid-cap growth space.
What's the one thing that would derail this thesis? The one thing that you're thinking on, that could be the thing.
Well, I think the one thing that could derail everything is, does the Fed, so everyone expects the Fed to go, the Fed has been very loud and very convincing, we're going to get to 5%, in and around 5%, we're going to stay there. But if the Fed gets to 5%, stays there for a while, doesn't like what it sees, and starts to move rates even higher, that can just derail everything. And that's the fly in the ointment for 2023. Does the Fed get more aggressive? We don't think so. We think they stay in and around that 5%, but that could be a major issue for us and for all styles and for all parts of the risk market and the equity market.
Hey, Chris, it's Jeff Mills. So I've been talking about this sort of quality growth thesis. Maybe the growth surprises people a little bit in terms of style leadership next year. You're talking about mid-cap growth. You kind of glanced across the idea that maybe that translates into large cap as well. So maybe hit on that a little bit specifically. And then are there any other areas sort of in the traditional S&P 500 names that you're looking at?
Sure. So a lot there. And let me see if I can take it all apart. The first thing I would say is just on the market in general. We think things have to get worse before they get better. Right? We think the equity market's going to go down in the first half of the year, but we will rally after that. And why are we going to rally? Because, again, it gets back to what's the macro backdrop. You have a lower growth environment, potentially lower inflationary environment. What has derated so far? Growth has derated from a price and from an earnings point of view. And that's when you have that macro backdrop, we think that's very conducive for growth stocks. And the S&P 500 is more or less the growth index. Within the S&P 500, one of the areas of growth, or where we think there's growth at the right price, is its media and entertainment space. There's a lot of former high flyers in there that are now trading with a real PE, and we think there's real value there. But at the end of the day, that fat pitch is still mid-cap growth.
Chris, great to see you. Thanks so much.
Great to see you, too.
Chris Harvey at Wells Fargo. Courtney, you like what Chris is pitching for 2023?
I mean, he definitely makes some really valid points here. Whether it's your large cap or your mid cap, I'm still really not overweighting growth here. I do think that some of your higher rates are likely still going to put some pressure on there. I understand what he's saying, though. I could see both sides of this, but I'm not overweighting this currently.
Yeah. Dan?
Yeah, it's funny. It seems like there's a lot of very smart investors, strategists out there who think that the prior leaders are not going to be the leaders out of this kind of bear market. And I kind of disagree with that. I just really feel like the way the market is constructed right now, the stock market, that some of the mega cap tech names, they're not even that impacted by higher rates because they have these tremendous moats, monopolies, their balance sheets, tons of cash, all that sort of stuff. So I'd fully expect like mega cap tech to lead when we do bottom. And those are the sorts of names that I actually want to dollar cost average at some point next year when it feels ugly, and you're going to have to kind of hold your nose and do it because no one's going to ring the bell at the bottom. But I think that safety in some of those kind of the Microsoft and the Apple and even the Amazon and the Google, I think that's kind of where you're going to want to be as we emerge from this bear market.